You know, so many investors see one big, impressive looking number, they feel that rush of confidence, and they buy. And honestly, that one number has cost people dearly. Today, we're going to uncover a trap that's hiding in plain sight and give you the framework to make sure you never fall for it again. Okay, let me just throw this at you. What if I told you a company had a return on equity of 73.1%? Yeah, 73%. I mean, that sounds absolutely incredible, doesn't it? It's the kind of number that makes you think, wow, I've just stumbled upon a once-in-a-lifetime investment. But what if I also told you that this same company is practically drowning in debt? We're talking a debt-to-equity ratio of a staggering 7.8. And its earnings? Well, they're not growing. They're actually shrinking by 6% every single year. All of a sudden, that beautiful, shiny number looks like it's hiding something pretty dangerous, right? And this, right here, is the central problem. So many retail investors get lured in by a single metric and they completely miss the big picture. But the pros, they use a system to see right through the hype. And by the time we're done here, you're going to have that exact same system. See, professional investors rely on a checklist. It's their secret weapon to avoid emotional traps and to see a company's true financial health. So we're going to walk through this 7-step framework that looks at a company from every single critical angle. I want you to think of this framework as your first and most important line of defense. Its main job isn't even to find the perfect stock. No, its job is to immediately kick out the dangerous ones, the ones that could blow a hole in your portfolio before you even know what hit you. All right, so let's put this thing to the test. We are going to run our mystery company through all 7 of these checks, right here, right now. And we're finally going to solve the puzzle of that crazy 73.1% number. Let's just break this down piece by piece. First up, the PE ratio. It's at 23.9. Our benchmark is under 20, so okay, it's a little expensive. Not a total deal breaker, but it's a little warning flag. But then look at step 2, ROIC, return on invested capital. This is huge. It tells us how good the company is at turning all its money into profit. At just 6.5%, it is way, way below our 15% benchmark. That is a major red flag. Okay, next, debt to equity. We're looking for a number under 1. This company, it's at 7.8. It has almost 8 times more debt than its own money. That is another massive red flag. Then we get to EPS growth, earnings per share. The profits are literally shrinking by 6% a year. That's red flag number 3. And now we get to our shiny object, the return on equity, or ROE. At 73.1%, it looks amazing, but surrounded by all this carnage, it starts to look really suspicious, doesn't it? Finally, we check profitability. The EBIT margin, it's okay. It's at 10.2%, so we'll give it a pass. But the gross margin is a measly 9.8%, nowhere near our 40% benchmark. This tells you the business has almost no power to set its own prices. So when you step back and look at the whole scorecard, it's a total disaster. So here's the billion-dollar question. How on earth can one number, that return on equity, look so good when almost everything else is a flashing red light? Well, the answer is all about how these numbers talk to each other. And this right here is the core lesson. The real power of this system isn't in any one step. It's in the way they all work together. Each metric gives context to the others, which prevents any single number from fooling you. And here is the magic trick, plain and simple. A company can go out and borrow a mountain of cash. Doing that shrinks the shareholder equity on its balance sheet down to almost nothing. So when you take your profits and divide them by that teeny tiny equity number, boom, you get a massively inflated ROE. It's not a sign of strength at all. It's a symptom of incredibly dangerous leverage. You know, the real enemy in investing isn't always the market. A lot of the time, it's our own brain. We see a number we like, and we want to believe the story it tells. It's called confirmation bias. But a system, a checklist like this, it forces you to look at the cold, hard facts, even the uncomfortable ones. It protects you from making emotional decisions based on an incomplete story. So how do we make this a permanent part of our own investing strategy? Let's go ahead and build that firewall. We're going to boil all this down into a few key lessons and a dead simple action plan you can start using literally today. Okay, if you only remember 3 things, make it these. First, never, ever trust a single metric by itself. Ever. Second, high debt is a double-edged sword. It can multiply your gains, sure, but it multiplies disasters even faster. And third, gross margin is like a company's fingerprint. It tells you if the business is strong or if it's one price war away from falling apart. So how do you actually use this? It's really simple. You can use any free stock screener online to find these 7 numbers. Then create your own little scorecard and just rate each one. And here's the rule. Set a minimum standard. For me, if a company fails on 4 or more of these checks, I'm out. It's an instant pass. No exceptions. And finally, always look at the trend. Are these numbers getting better over time or are they getting worse? Look, if this changed the way you think about analyzing a stock, even a little bit, do me a quick favor and just drop the word 7 in the comments below. And hey, if you want to see this framework put to work on a real company, you have to subscribe. Because next week, we're taking this exact 7-step process and applying it to a trending stock that's all over the internet right now. We're going to see if it's legit or if it's a trap. You are not going to want to miss it. And last thing, just a quick and really important disclaimer. All of this content is for educational and informational purposes only. It is not financial or investment advice. Investing involves serious risk, including the potential loss of your money. So please always do your own deep dive research and consider talking with a qualified financial professional before making any investment decisions.